So good evening, folks. Thanks for taking your time out of your busy schedule to make it to this webinar. Definitely, you have choices and you definitely made a choice to come here. So today, a webinar is going to be about super trader mindset. So what is a mindset about having a super trader? That's what we are going to talk about. Okay. um, for consistent growth and returns. Okay. Before we get started, I just wanted to talk a little bit about the disclaimer. All the information presented in this video is only for educational purposes. However, the viewer can use this information for making their own investment decision. However, they are solely responsible for those decisions, and techie investor would not be responsible for it. So having taken care of the disclaimer, today's agenda is just to note this webinar is we have done it before, like about 3 months back, in October or November of 2020, not 3 months back, quite a while back. We thought it is worthwhile to bring it back, especially with the way market is behaving, so that we can have some sanity and keep on working on our processes rather than worrying about the outcome. Okay. So the agenda for today will be, the first topic will be the easiest way to grow a small trading account. Then the next one will be talking about the trading laws, some of the laws that everybody needs to know and try to abide by them as much as possible. Then we'll talk about the 3 trading components that are very much essential to be a trader. Okay. This is the main thing that we need to have, and we need to keep working on it consistently. And finally, but not the least, is the 5 elements of successful trading. What are so we'll divide those 3 trading components into processes, 5 trading processes that we can use in our daily lives, like how we can implement them, and how can we get better, can become a better trader than yesterday. And finally, we'll talk about in a synopsis how to grow the small trading account. Okay. So having said that, so easiest way to grow fast, right? Let's say a lot of people who come into trading, they believe that it is the way to go rich fast. And it is true in a certain way. Basically, if you double on every trade, let's say you have $500 and you double on every trade. So it becomes a geometric progression. So if you go this way, how many trades do you need to become a millionaire? How many trades would it make it to the million? Anybody? Any guess? Okay, that's eerily silent. Okay. Whopping 10 trades to have $1 million and have a winning dance. So it's as simple as that, to have 10 winning trades and you can make it $1 million, right? But the real question is it feasible, right? So the real question is it feasible? So absolutely not. If you know the trading statistics, I have put in very liberal numbers here. Only 5 to 10% of traders are successful, but it is much more staggering. It is only 1 to 2% of the traders are successful. The people who are successful, they understand that capital preservation needs to be done through the position sizing and understand the trading laws. Okay. So this is the most important concept. It doesn't matter whether you're a technical trader or you have all the technical knowledge, but if you are not doing your position sizing, then it doesn't make sense, right? You trade to live another day. Okay, that's what I know. We hear the concept of YOLO, you only live once, but it sounds great, but it does not seem to be very practical. Okay, so let's dive deep into this. What are these trading laws? So the number one is always take care of your downside through the position sizing and the risk reward ratio. So the position sizing is very, very critical, folks. If we'll talk about it in much more depth later, but always take care of your downside through position sizing and risk reward ratio. Second thing, consistent action leads to consistent results. It's like this, guys. If you're trading, you got to be very consistent in your actions. you like, to make, to get the consistent results. It's not like I trade here and there and then you would not be expect to make a lot of money in that. The third thing is develop an edge in the market. It doesn't need to be a very sharp edge, but what I'm saying is at least that could get you up to 20 to 25% for the year. If you can develop an edge, then it'll be good, it'll be better. Fourth is work with large numbers. What I mean by that is small accounts lead to small profits. Big accounts lead to bigger profits. So we need to think about ways of growing our account, and we need to think about how we can make our account bigger. Okay. The fifth one is also the thing with the fourth one. Money is needed to make more money. This is very, very common, right? If you take any hedge fund, they have a lot of money, but they go and collect funds, because as the money becomes bigger, the risk becomes lesser and much more profits are done. We'll talk about much more in detail in the next. Then leverage the power of compounding. So this is a very important concept. Now you might be asking, hey, if trading is so risky and about only 1 to 2% of the traders are successful, then why do people trade? Why can't we just invest our money? The reason is, if you trade and you make, this is because of the simple reason of power of compounding. Let's say you make a double on every trade, as I mentioned. Let's say even if you don't make a double, you make 20% on every trade, and you keep investing that money, it compounds very fast. Rather than the investing is like you are one time and then do that. That is why they say even in the investing world, your money grows faster if you do dollar cost averaging, because of the power of compounding. So the power of compounding is very effective. So we should all definitely strive to take advantage of how we can leverage this compounding. Okay, that's one thing. Then this is one thing, folks. How much ever you do, no single best trading strategy will work 100%. What do I mean by that? If you look into any trader, successful trader, it has been proven that on an average they have only 70% success ratio. Now, you will not be successful in all the trades. That is why it is very important to have the position sizing and the risk reward ratio. That is very important in this way. So then the third one is the higher frequency leads to more profit. The more consistently you're taking action, the more, and of course you need to have a process in place and you need to take the action. That will do. And finally, but not the least is trading is a slow rich scheme, guys. It's not like you can become rich overnight. I mean, you will get some trades like what we had in some of the trades like Google or Game, but ultimately it's a slow rich scheme. I mean, it's much more rewardable, but reward is greater, but you have to manage your risk. Okay, so these are the 10 trading laws that we should always remember and abide by it. Then the next one, I wanted to the 3 trading components. So if you look into this, if you see the 3 trading components, any trader should understand is, for to be a successful trader, the 60% is dependent on the trading psychology, and the 30% is dependent on your position sizing, and only 10% is on the systems. That means, what do I mean by systems? Systems is your technical analysis, if you are using fundamental analysis, your quants, whatever you use for your investment or trading decisions. But if you look at it, the trading psychology makes the most of it, 60%. So what kind of a person you are will determine what kind of results you get. Okay. And the second is position sizing, which is 30%, which we'll talk much more in detail later. But position sizing plays a very key role in that. So moving on to the next slide, what is trading psychology? It's all about your beliefs, guys. What do you believe about yourself? Since trading involves money, what do you believe is your relationship with money? Some people say money doesn't grow on trees, or some people say, hey, money is the root of all evil. I mean, do you have these kind of beliefs? So what I do, and if you have those kind of beliefs, then you have to ask yourself the question, hey, what am I trading for? Am I trading for money, which is the root of all evil? Is it like in alignment with your beliefs that money would get what you want? So, that's the thing. I'm not saying that it's a right belief or a wrong belief, but it is something that you have to think about yourself and work on it. Okay. So trading is definitely involved with money, and and so it is very important to understand your relationship with the money. Okay. Then the third thing is, what do you believe about markets? If you think this is a very classic, right? Um, if you think the market is very overextended and you're trying to place a trade which is like on the uptrend, you're betting that the call, is it aligned with your belief? If it is not aligned with your belief, then why are you placing the trade? For example, a very common example that I give is, if you are a value trader who is looking for only dips, well, would you be willing to trade trends? Trends are like, if the stock is going up, it is going up. That's a trend trading, right? But as a value trader, would you be able to do that? So you got to understand what kind of a trader you are, and definitely and trade according to your beliefs. Okay. There are some people in our group who are value traders. There are some people who are in the group who are trend traders, and there are some people who are band traders. Band traders are like you take the Bollinger Bands and you say, hey, if it comes to the bottom of the band, I will trade it so that it goes to the top of the band. They want to be clear on what is their exit point from the place where they enter. Okay. And some of them play breakouts and trends. Okay. So there are different kinds of trading mechanisms here. So we need to determine what kind of a person we are and what kind of trading can we imbibe on. Okay. That's what it is all about. So what are systems? Systems are the framework that gives you an edge for over the market. So you can have more than one system for different market conditions. You can measure by the winning probability and the number of trades it produces. If you go to a returns page on the winning tracker, we track all these things: R multiple for every trade, mean risk, standard deviation, and so these are very, very important to track the performance of the system. A system with a ratio of 0.25 will be profitable, greater than 0.25. So right now, last year, our returns were like around 0.34. So that basically, if you have something greater than 0.25, then we are pretty much profitable. Okay, that's what it is. So we can talk about it more in detail, but if you go to the returns page, you'll get a lot of information about this. Okay. Position sizing. This is the most important thing which we are talking. What is position sizing? How much you allocate per trade in terms of risk. So you got to understand, same portfolio can have different results if the amount elected to risk is different. For example, even again on the returns page, for the same trades, if I allocate 2%, my rate of return would be much less than if I had allocated 5% for every trade. So, but again, it depends upon what kind of a trader. Are you trading to not lose? Or are you trading to get the maximum wins? So it all depends upon your trading psychology. I mean, what is your trading mentality when you come in? What is it that you are trying to achieve during the trading? So as I mentioned here, an academic study said that 91% of the performance of 82 retirement portfolios are due to position sizing. So people who take high risk may get higher rewards, but when it falls down, it may fall also big. So that is a typically, if you are very aggressive kind of investor. But if you are a value investor, your returns will be less, but you also will see not much dip in your portfolio at any point of time. Okay, so that is position sizing. Now I wanted to talk about how can you become a super trader. So I remember the 3 elements I talked about. We need to work on those through the 5 elements of successful trading. Okay, what are these 5 elements of successful trading? The number one is the trading process. Do you have a process in place? If you have, then are you implementing it? Okay. The second is the wealth process. Do you have the wealth mindset? And if not, how are you working towards it? That's what we're going to talk about. The third is the trading plan. Do you have a plan written somewhere which talks about how would you do the trades? How would you manage your system? How would you manage your portfolio and all those things? We'll talk in much more in detail. Fourth is the systems. Do you have systems that are working for different market conditions? Okay. Then finally, 5 is the position sizing. This is the most critical element, as I said, the 30%, right? So these are the 5 elements of successful trading. Sorry, folks. Amber. So, position sizing. Okay. So trading process. This is the definitely what are your daily procedures, right? For example, how do you keep mentally and physically fit for trading? Uh, I just mentioned a few things here, but it could be something that you can take it up. But to get a clear understanding and to get a more, I highly recommend you to read the book Super Trader, where he talks about it where much more detail about what kind of a person you are. In fact, there is a test there to determine what kind of trader you are. And then based on that, you can determine what are your activities that needs to be done. Okay. So I would highly recommend that book, Super Trader by Van Tharp. He runs, he also runs neurology, he combines trading with the some mindset, okay? And he does a lot of workshops for like institutional investors and other traders, okay? So that's one thing. So how do you keep mentally and physically fit for trading? Then some of the steps, what are the steps you take before you enter the trade? Do you look at the big picture? Do you look at stop loss and follow through before placing the trade? Then third thing, this is very important, guys. How do you keep yourself sane, especially with the way the market is choppy? Do you keep watching the screen all day, or do you keep talking about it the whole day? How do you keep yourself sane and look for more opportunities in the market, right? So one thing, folks, market is always providing you the opportunity. It is up to us whether we get to see it or not. It all depends on our mindset at that point of time. Okay. So the fourth thing is, how do you bounce back when the trade goes against you? If the trade is going back, do you have a backup plan? Okay, how do I get out of this? Yeah, do you have a stop loss in place, or do you have the position sizing in place? If it is there and you want to capitalize on more, sometimes we do averaging it out, or sometimes we can play the reverse side, playing the puts and all those kind of things. Then you can say, how do you monitor and minimize the number of mistakes you made? For example, we all start at a point A, but we will be starting with mistakes. But as you go through, are you journaling them? Are you journaling the daily things that you do, and make sure that you're not repeating the same mistake twice, right? It's like this, right? Doing the same things and expecting different results is insanity, right? So same thing, you have to have a set of rules which you define your trading plans and system. Again, guys, trading plan is an evolving document. It is not like a static document. So you need to keep stating your observations and noting it down. And this will create wonders for you guys. Like once you start journaling them, you will start noticing the same patterns, and you will be able to make quick decisions whether this is good, this is for you or not. One thing I want to tell about this at this juncture is, you got to understand, if you are buying let's say you're buying equity like a stock, let's say Apple, there's somebody else selling on the other side, right? Now, how do you know? Now you are buying it to make profit on the upside. He is selling it so that he can make profit on the downside. Now, who is right here? Who is wrong here? There is no right or wrong answer here. The reason being is different people have different time frames, right? They look for different time frames to make their profits, to get their entry and exit point. So we got to respect it that we don't know it all, and we should also always be ready for the backup plans if it does not go against us, if it doesn't go as per our plan. Okay, that's what it's all about. So the second one is the wealth process. This is very, very important, folks. I keep asking in the room also, why do you trade? Is it to attain wealth, or the cash flow, or the cash flow? It's like this, right? If let's say you want to go from point A to point B, but you don't know where the point B is. How would any vehicle take you to point B if you don't know where you want to go? So you need to know where you want to go. So you need to have well-defined goals for the week, for the month, or for the year. So in that way, you can keep fine-tuning the processes so that it can enable you to reach the process. So this is very, very critical for goal setting. Is very, very important. It should be measurable. It should be simple, and once you have these goals, it's very easy to find a way how to get there. But having a goal is very, very critical. Then the second one is the thoughts create action force. So we need to understand ourselves and our beliefs. This is a critical component, and that makes it all work. So it is worth spending some time knowing ourselves and working on it. And then the third, as I had already mentioned you, it's a beliefs, all about yourself, about the money wealth, about the markets. We already talked about that in detail. Then how do you wealth process, how to work? There are three attitudes that we always come in with the market. One is the pessimism, one is the neutral, and one is the empowerment. I highly recommend you to be in the empowered attitude, which can be achieved through affirmation, right? Believe in affirmations that you can get the work done, okay? Anything, thoughts create actions, and when you have the right thoughts, actions will follow it. Then the trade through mindfulness. Observe what market is doing. Focus on the price action. One of the things that could help you in this way is the meditation. Then looking from multiple perspectives. Remember, as I said, it's from yourself. Like what are you looking to achieve from the trade? And the second one is trader on the other side. Then you can also become like, detached and say, and observe from the sidelines. What is the thought process that you are going through and what is the market actually doing? So these are some of the ways. I know these are not very easy to do. It's like very abstract, but this helps us to have a perspective what is happening. Okay. Then achieve balance in trading and investing. This is very, very critical for. Understand that there will be losses where there are wins. If you're playing a sport and if you expect everything to be a win, then we are in for a lot of pain, right? Because where there is a win, there is a loss. Similarly, trading involves money, and we are going to where we are gaining profits, we will also have losses. So we got to understand that, and we should be have that balance in the investing and trading. Okay. And these are some of the good books I would recommend folks to read. As I've already mentioned, Super Trader, I would highly, highly recommend you to read this book. This enables you to know yourself first, what kind of a trader you are, and it will enable you to know the systems that you want to achieve your goals. Okay, this is one of the best books I have ever read, and it is also very highly recommended by most of the traders. The second thing is the trading in the zone. This is very, very important if you are in the market and you are looking at actively trading in the markets. You need to understand how to be in the zone, irrespective of whether you get the losses or wins. Okay, that's one thing. And finally, this is one thing which I like: vitamins for the soul. This helps you to stay positive. I mean, at least for me, it helps me to stay positive. Every day you can read one of the things, and then this helps you. So these are some of the books I would highly, highly recommend. Definitely the Super Trader and Trading in the Zone are the two books that I would highly recommend if you want to be, for your trading activities. Okay. Then the next one is systems. So far, any questions, folks? Am I going too fast? Are you able to follow me?
No, you are fine, Ashrini, but I have to exit now.
Oh, okay, sure. I have a recording.
Yeah.
Okay. So systems, do you have a system or framework in place with well-defined criteria for the different market condition to execute? So then we have this metrics, which we already talked about. Again, I wouldn't go into much detail about the systems, Then position sizing and risk reward ratio can be used together. Beginners need to start with 1 to 2% position sizing of the portfolio. So why is this? Okay. Again, the three components is again the trading psychology, then the trader's objective. I do not want to go bankrupt. I want to win at any cost. What is your objective when you come into trading? But a very popular method for position sizing is the cost price ratio model. So this is called CPR. How much of your equity are you going to risk? How many units do we buy? P. And then how much are you going to risk per unit? So that is what it is, R. So P is C by R. So let's take an example. You buy weekly Facebook option with a risk of 50% per contract for $5. You want to risk 2% of your 10,000 portfolio. I'm sorry, this is 100,000. How many options would you buy? So let's say your risk is 0.5 and then your C will be 2,000. That is 2% of 100,000. So your P will be 2,000 divided by 5. If you know that when we say 5, it's 5 into 100. Then your risk is 0.5. You will buy with 8 contracts, right? Now with 50% stop place, that means you will buy 8 contracts and you would sell it off if the price reaches $2.50. Does that make sense? Hello? Someone here? Am I talking to myself? Hello? Okay. So the other way to think about is you buy weekly face book option with a risk of 100% per contract for $5. You want to risk 2% of your 100,000 per. How many options would you buy? So it's R is 1 per contract. So you will end up only buying 4 contracts. So that means your risk is always $2,000, but you will buy the number of contracts as per your risk reward, as per your risk. So if you want to buy more, then you have like 50% stop place. If you want to buy, I'm okay with losing all the 2,000 you'll do. Ideally, you'll be profitable if you're making more than 1 hour per trade. So equity models, multiple models are available. So we are going to talk about 2 models here, which are very popular. Let us assume we are allocating 10% per trade with a total portfolio of 100,000. So core equity is subtract the allocation of the trades place and take 1%. So let's say 1% of 100,000 is 1,000. The first trade you will make $1,000. Now you will have left 99,000. That means for the second trade, you will only make $990. For the third trade, you will have only $9,000, $98,100. So that means you will only take $981. So this is what the core equity is talking about. Okay. Now this doesn't take into consideration whether you had a loss on the trade or you had a profit on the trade. It just takes the actual amount. The second one is called the total equity, which is first trade is $1,000. Let's say its value came down to 800. Then the second trade will only be $992 because we are in a loss. And then it actually takes into account the profitability and those things. So any questions, guys, so far? Hello?
It's really sounds good, man. Continue.
Okay. All right. So this is the one thing. So the last but not the least is the trading plan. This is why I highly recommend you to have a trading plan, which is very important, folks. What is your mission statement? Like, why are you doing trading? It could be a very high level, maybe to help your family out or you to help others grow as successful traders, whatever it is, like, it could be, but what are your goals and objectives? To achieve that mission, what is your goal? You cannot go from A to B if you do not know what are A and B. So make extra $1,000 per month to pay my course on college education. This could be one of your goals. Basically, I just gave an example here. What are your trading and market beliefs? So you can say, I'm a trend trader, identifying trends in the market and riding with it. Trends can be upwards or downwards. Then what is the big picture? Like you should know what is the big picture that affects the market. That means if let's say if there is a big 9 by 11 event and you expect the market to go up and you are not even aware of it, then that's a big thing, right? You don't know why the market is going up. You should be aware of the big picture, like the COVID, the Fed rates, unemployment numbers, like the Fed meetings that happen every month, all those kind of things. I would highly recommend you to go through the big picture. So these are the things that you need to write it down. These are the events that you should be looking for. For example, if you're thinking of biotech stocks, you should know, hey, when are they going for their approvals? When are they going to go for testing? All those kind of things. You should have a view of what you should be checking for. And you should write it down in your trading plan so that you follow it to the T. Then what is your tactical trading strategies? Some of you may be using Ichimoku trading strategy with a minimum of this much accuracy, whatever. If your accuracy was less, it could be less. And as you become a good trader, your accuracy will become more. So works in all kinds of market condition. Then you can say, we'll remove half a double. I have a mental stop loss to remove if it breaks the original condition on which it was entered. Okay, that kind of a thing. Then plan for position sizing. You want to do max of 5% or minimum. Again, all these things I gave in the subsections are examples. You should have these things noted down. What is my plan for position sizing? What is my tactical trading strategy? All those kind of things noted down. So what are typical psychological problems in following? Let's say you created that plan. Now, what are the typical psychological turnout? If you're doing options, you should be ready to lose the whole position with the option. So have to be very strict about the position sizing so that we don't blow the account. This is one of the challenges that I faced when I started options trading. But for you, it could be a different psychological challenge. Maybe you're not able to remove the money quickly when it is going south, or you are not able to sell it when it is needed to be, whatever it is. So you have to do that. Then what are your daily procedures? How do you prepare yourself for the markets? Just like how you prepare for your work. How do you do, there are different things I mentioned here. Meditations with positive affirmation, physically and mentally ready for the day, having some workouts, look at the big picture, then take 50-minute breaks in between, checking constantly if I'm mindfully trading. Best way is to write down the ideas. When you write down, your mind slows down, and you can start thinking very, very clearly, is this trade worth it going or not? Analyze and identify the mistakes made during journaling. Guys, I cannot reiterate how important journaling is. You have to journal every day. I'm not saying every day, at least you should journal and see what are the whole purpose of journaling is to make sure you're not doing the same mistakes twice or more than once. The whole goal is to become a better trader every day, okay? So, and also reward yourself, guys, if you did not do the same mistake again. That is very, very important. Rewards enforce positive thoughts, and that will enable you to trade better, okay? Then what is your education plan? First of all, folks, you should understand that you don't know it all. Definitely, there is something that we all don't know. It is very, very hard to know what is happening in the market at all times. So we need to lean upon people who might be able to get that information, like sources. Some people follow some analysts, some people follow sites like Benzinga or CNBC, those kind of things, right? So the critical part is knowing that you don't know it all. Then associate with successful traders, like like how you are associating in this trading room. Then also YouTube, Twitters, blogs, whatever. Then third thing is control the context flows. If you are planning to make something like $5,000 per month, is it okay to spend $100 on education? Of course, you need to take action from empowerment. You need to feel the need for it, right? Well, if you feel the need for it, then you need to take it in the context. How much am I going to make? Then have a plan, have an education plan, what you need to know to achieve your objective. So whatever I talked about it, folks, is something that only you can work upon. As I mentioned, if you know what is your objective and when you want to reach it, there are people who can help you out. But if you don't know where you are going, then it's very, very difficult to get help. Okay. This is very, very important, folks. What is your disaster plan? Let's say, like what market has been going against us, and it is okay to have a disaster plan and remove all the element, all the calls or puts that you have, because that is in alignment with your objective. Your goal is to see what is your disaster plan. When will you remove all your positions? You need to have a plan for it. When will you remove all your positions? If it goes, some people might say, hey, if my portfolio goes down by 15%, I will remove all my portfolio positions, because I'm going to talk about it in much more detail. If you lose 80% of your portfolio, it takes 400% to get it back, folks. It is not a joke. It is not a joke to make 400% if you lose 80%. So you got to have a disaster plan. This is very, very critical. How much ever you say, your position sizing, your objectives are the only ones that matter. It is very, very critical that we take the ownership for ourselves and implement the disaster plan if needed. Okay. Okay. So this table will give you an idea, folks, how much it takes to recover your portfolio. Be mindful about your portfolio. If you lose 10%, it will take 11.11% to get back. If you lose 20%, it will take 25% to get back. Remember, whenever you're losing, you're playing with less capital. When you're playing with less capital, what is going to happen is you have to make much more to get back what you want, what you wear. Okay. So if you lose 30, it goes to 42. Remember, if it goes more than 50, it takes 100% to get back. So 60%, 150, 80%, 400. So you never want to get more than 20% down in your portfolio, and you should have. That's what I would recommend. You should have a disaster plan for it, and you should get out of all your positions and make a alternative backup plan for it. Okay, that's what I would suggest. So then these are all very pretty trivial, but what are your expenses? You need to know, are they realistic compared to your income? If your expenses are more than your income, then that's something that you need to think about and say, hey, how can I get my income more, or how can I reduce my expenses? Then accountability. Do you have systems in place to track your trades? How would you share? How would you measure? So you need to have some kind of Excel spreadsheet or something talking about your trades. So one thing very, very important in trading is accountability, folks. You're trading for yourself and you need to have the accountability on this. So then third is, how do you prevent mistakes and avoid repeating them? As I mentioned, one is journaling. Look at multiple ways the trade can be seen. If you're buying, someone is selling, what is the thought process? Then take a moment to write down the trade before executing the trade. This is very, very critical, folks. You need to write it down. I promise you, if you write it down, you will slow down. It will enable you to think through all the things. Okay, that's one thing. So for those people who have a very small trading account, I would still recommend to have at least 25 to 30K to do trading, folks. If you do not have, work on accumulation. Meanwhile, work on the systems and do the trading, and definitely have a trading plan, folks. Never get into the trading without a trading plan. Have small position sizing, 1 to 2% per trade. Work on a system that provides you an edge, maybe at least 20 to 25% per year. Then reinvest the money, understand the power of compounding. This is very, very critical, folks. As per trading law, money makes more money. We talked about it already. Hedge funds always continuously works on increasing the capital. As you add more money, your position sizing gets bigger and your risk gets smaller. So the goal is to grow it slowly and steadily, and not to shoot for quick risk schemes. That's all I had for you today, folks. So any questions? I know this is very, very abstract and it is very, very challenging, but this is very, very needed for trading, folks.